Hi guys, this is Simon with Trade and Perform Coaching doing the trade review for Friday, July 10th. Really interesting day, really good trade day. We opened the room to the general public, meaning non-members, to show a little bit about what we do. Remember my objective, and I have several objectives when I come into every trading day, and I want to be clear what those are. I want to follow the three C's, which is clarity, commitment, and composure. Right? First of all, clarity on what I'm trying to achieve. I'm looking for 1 to 2 good trades a day that'll generate two points of profit and leave some profit for trailers. Number one. Number two, I want to look for my high odds opportunity and be clear what that high odds opportunity looks like. All right. And lastly, in that clarity, I want to understand that how keeping consistent from day to day will add up to a larger trading account over time. How will that P&L work? And then the last piece that I want on clarity is I want to know that my trade plan will keep me from having a significant drawdown in my trading account or wiping myself out. Right? All of that requires, number one, a written trade plan. Okay. Number two, being very clear on what your entry, exit, and stop is on every trade. Right? And then the last piece is accepting, and this is really the hardest piece. It's accepting that there's some markets that you're just not going to get. Right? You have to be able to recognize the market that you're in, and that B, if not getting every trade is okay, that there's actually very few people who can trade everything, but what they do is they find very few things that they trade extremely well, and when they see it, they kill it. So let's jump into the day. What was the first issue of the day? Let's look at a larger chart. Number one, let's put the pieces together. We had trend day down the prior day, and then we gapped overnight. All of this has been revolving around the news coming out of Europe and China, right? China has rallied significantly in the last couple of days. Clearly, there was some concern about what was going on in China the day before, and that concern got wiped out overnight, number one. Number two, we've had 2 days in a row now where we've had significant downside closes, and remember, statistically, closing on the low of the day is a rare event. To demonstrate that, if you want to go back and look and get clarity, go back to August 2011, late July, early August, and you'll see that was one of the biggest corrections. That was almost a 20% correction within the period of 2-3 weeks. And even in that environment, we closed down in that small period of time, but was extremely violent to the downside. We only closed to the downside about, when I went back and counted, I believe it was 40%. 4 out of the 10 trading days where we had the most amount of violence to the downside, we only closed at the low on 4 of those 10 days. That means someone who bet on a close to the low of the day actually ended up losing money in one of the biggest corrections that we had had since the crash going back to 08, 09. Right? So that's a really big deal, right? That should really tell you whenever you get that impulse or that decision to short at the end of the day that we're going to roll over and fall apart. It rarely happens. But the last 2 days were great examples. They were also great examples of how you could have someone who's not on the day time frame, right? On the overnight time frame, why staying short in the hole is so difficult. Imagine someone who had shorted here, had gotten all the way up on their position here, right? Imagine the stress of coming all the way back up, a full from 2040 all the way to almost 2070, 30 points, right? They finally think, I finally got it. We're down at 2040. We're going to gap down and come test 2000. Then the next day, which was yesterday, we gap all the way back to 2070 and push all the way to 2075. It's enough to pull your hair out. It's why I don't like swing trading overnight. And if I do, I certainly don't like swing trading to the short side, right? I prefer to, if I love to short, I just love to short intraday. Okay, so the next piece that we were trying to put together, if you look on a bigger picture, there's an open gap sitting right above at 2075, sitting approximately right here, maybe 2075 and change, 2074 3/4, something like that. But this is where that open gap was sitting. And markets like to close open gaps. I believe currently there's an open gap at 2005, 2015. We have this at 2075, and I believe there's another open gap at 2095 right now. So, very importantly, the market is going to gravitate towards those magnets whenever possible. So if you look at the formula of what was going on here, what was driving these down days was essentially Europe, Greece/Europe, and China, right? Well, if you came in and I don't really analyze the news, but I know that Greece has kind of capitulated to the EU demands, or at least are trying to now, right? And that China's pretty much made selling stocks illegal, so their market has stabilized. The two big drivers that you had attempting to push the market to the downside had gone away. So that kind of left me with a bias of being long. Additionally, when we come into the day, what are we looking for in a gap up? The first thing I want to know is, are we having an open drive higher, open drive lower, right? Are we able to attain gap fill, which obviously we were miles from, and are we able to get half gap? Well, if we look at half gap, right out of the gate, go. $20.64 was half gap. We came nowhere close to getting to that half gap. So I'm reluctant to fade a market that gaps up that strongly, and I listed the reasons in the pre-market for that. First of all, even if we're not going to run, we're likely to have balance. That was really my first call of the day. If we didn't have open drive higher, right, which we would have known really in the first 15 to 30 minutes, then I was looking for balance. So let's go look at this day. What was the characteristic of balance? First of all, look at the range we had in the first hour here versus this range. This range basically covered us from 2067 all the way down to 2053, over 10 points of range. Here we opened at roughly 2069, and we barely got to 10 points. Now, this is all a context issue. If you go back and look even a month ago at the ranges we were having, if we had 10 points, we would have said, wow, that's really fantastic. That's a wide range. But compared to the opens that we've had over the last couple of days, 10 points is relatively narrow. I said if we were at 10 points or less, that I'd likely be looking for balance. And then I know when I'm looking for balance, what are my patterns? I have straightaway square balance. This is great because basically new highs get pushed back into the middle and new lows get pushed back up into the middle. And I basically want to trade at the edges. I can also have balance with a downside bias. So that brings me to a market that looks like this. But even with that, each new subsequent low tends to get pushed back up. And then when I have a balance with an upside bias, and that is a move that goes like this, right, or similar to this. And if you'll look at this concept, here is the low that was established in the first hour. We dip below that low, push back up into the range. In this case, we had developed an upside bias. We come, set a new high, trade sideways, pushed back into the middle. All right, then we come back up, we set a new high. This completes the auction to the open gap, and then we make an attempt to push back in the middle. So this, I ask all my coaching clients to always print up different charts of the day, get them printed, put them in a portfolio book that you can look at easily. This is open gap that turns into upside balanced day. The characteristics being new lows get pushed back in, new highs get pushed back in. And who this kills as a trader are those guys who cannot wait for the pullbacks, right? These guys get absolutely murdered. They chase at the highs and they get smoked on the stops, only to come back and watch it set a new high, or they chase at the lows, think we're going to come in and fill, and they get smoked back to the upside. That kills momentum, most momentum traders. And you have to remember, if you're trading ES, which is my primary instrument, it does not suit itself well to momentum. It can be momentum traded, but it is not momentum traded enough of the time to make money. The majority of the time, it's a product that reverts to the mean, and you can see it likes to do that all day long as it passes through the middle of a channel. Almost any direction that it moves, it tends to have reversion moves, right? Except on the most aggressive of up days and the aggressive of down days, right? So we accomplished something right out of the gate. We established that the rotation in the first 30 minutes and in the first hour were smaller than the average rotation of the last couple of days. That leads us to believe balance. We were unable to get half gap. That leads us to believe buyers are in control, right? And then last piece is we have evidence that we snap below first hour low, snap back into above first hour low, trap the traders, take it to a new high, take it back into the range, we immediately get evidence that we're most likely in balance and that patience is required, right? So the next move that we have, early on when we opened up, and I want to go back to the chart that I posted both on StockTwits just shortly before the open for people who were joining us in the meeting and to the members the evening before. When we look at this, okay, we can also see that we opened below Globex high, rejected out of Globex high, pushed down, right? Now, the first thing that I said that we were looking for in the market preview, remember, having a plan, having some concept of what you know you're looking for. Mark Douglas talks about this, and this just isn't a fact of the idea of, and Brett Steenbarger both talk about this. This isn't the idea of just not figuring it out on the fly. It's in addition to the more you have to think, while you're trading, the more questions you ask. The more questions you ask, the more questions come up, right? And then your brain goes searching for answers, right? What about this? What about that? And then 10 other questions spring off of that. Almost every trader I know suffers from one form of anxiety or another. They suffer from either, will I get the trade? Should I take the trade? Where should I stop the trade? Where should I exit my trade? Mark Douglas has a very clear prescription for solving this problem, reducing your anxiety and letting you focus on your setups, and that's very easy. Have whatever your setups are, you develop them one at a time, and you know your entry, your stop beforehand, right, and your exit beforehand. Now, the exit part, believe it or not, it's not the stop. The stop is the second most frustrating part. The most frustrating part for most traders is the exit part. Why? If my exit is 2 points and the thing runs 20 points, I want the 20 points. Well, I want it too, right? But there's a couple of functions that go in to being able to capture a 20-point move. Okay, first of all, scaling. Scaling is very, very, very important. Why? Because we never know whether it's going to go 5 points, 10 points, or 20 points. We simply do not know that answer. There's no way you can know it. You can say, this is a good location. You can say my targets are above, but you never know for a fact. If you don't scale at all, right? If you don't scale at all, it's always a all or none proposition that can lead to an enormous amount of frustration trading the ES. On the other hand, when you are someone who's practiced in scaling and letting the rest and leaving trailers for it to work, you first of all soothe your anxiety levels and your pocketbook by seeing P&L slowly go into your account. Secondly, you can plan to increase trade size as your profits increase. And then the last piece is as you already have your exits preset, you don't have to constantly analyze every little tick and be on edge. You already know, for example, at 2 points, I'm scaling a quarter of my trade. Okay? At 4 points, I'm scaling another quarter. At 5, I'm scaling another quarter. Then I'm leaving the trailer, maybe for 7, 8, or 10 up. Whatever your trade plan calls for, right? Obviously, that trade plan has to adjust a little bit, given the ranges that we may be experiencing in the time of year that we're in. For the smaller trader, you have two options. If you don't scale all out at 2, and it's hard just to be a single contract trader, I'll be the first one to tell anybody that, right? You're constantly on edge going, well, I could have had 4, I could have had 10, or I should have held on. That's a very difficult way to trade. And it's for that reason that I've introduced in the room, multiple reasons, but one of the reasons why I've introduced the use of binary options as opposed to using futures contracts for smaller traders. What's the reason for that? First of all, using binary options gives you permission to take the trade without worrying about unlimited downside. You can only put so much money on the table, and there it stays. You can't lose more, whether you're paying $34, $50, or $70 for the contract. That's the most you can lose. You still have to be able to accurately predict an inflection point, right? A pivot point in the market where you're going to get a rotation up, but your downside risk becomes limited to the extreme, right? Next, you take out the time feature. In each of the zones, if you remember the rules, as people come into the zones, first time into the zone, you scale for 2 points, your stop is 2 points behind. But there are times where you come in, and first of all, if you're taking the top of the zone and your stop is 2 points behind the back of the zone, that's 4 points. There's a lot of traders that are simply uncomfortable with risking $200 per contract on every trade. For the client who takes the option trade instead of the futures trade, he can limit his risk, at least per trade, to $20, $30 per contract traded, and then do a multiple, whatever fits into your proper risk parameters of your trade size. The point being is that you can scale down in risk and the amount of dollars that you're risking and still engage in the market in a learning process, right? This goes back to something that both Andrew Menaker, Dr. Steenbarger talk about, and also Mark Douglas. All of them have written great books, by the way. I recommend all of them. And that is, if you have so much risk and you're so tied into the outcome, two things happen. First of all, when you're tied into an outcome, you ignore all other information that the market's feeding you. You cease being in a learning mode. You have switched to a I need an outcome mode. And naturally, when you have to have an outcome, you're going to start to ignore all the other inputs that the market is giving you. You're no longer learning. You're simply needy, and you only will accept information that supports your thesis, right? But if you've locked in, let's just take this trade here. A trader who has taken, let's just say, for example, 10 contracts, and he's gone, I'm totally comfortable losing $2,000 at this inflection point, right? Taking 10 contracts, $2,000 is my risk, and I know I have a win rate. Let's call that win rate 67%, right? And I know this also falls into high odds. It's had a huge stretch. This is well beyond the 4.25 to 4.75 stretch. That trader can take this trade without fear. Perhaps this trader has a 200K account, right? So he takes those 10 contracts, and he knows if he gets stopped, he's losing less than, well, it's a very small part of his account. I believe that's 1%, but I'm terrible at math. Okay, so the disadvantage of being dyslexic, I can see chart patterns, but I'm just nightmarish at math. At any rate, moving on with the concept, very small risk, right? But now you have a client who has, let's say, 5K in his account, right? And he wants to put on 2 contracts, which is a lot of leverage, okay? And he takes this same trade. Well, this 5K trader with 2 contracts views this loss. If he takes a 4-point stop at this zone, that's $400. He views that as a 10% risk to his account. And you know what? He's right. It is a 10% risk, and it's probably too big a risk relative to his trading size. It requires him to be constantly perfect. Even with 1 contract, he's approaching 5% haircut every time he takes a stop. Let me make sure I got my math right on that so that I'm not crazy here. Yeah, close to 5%, it's 4% technically. So that's still a very large haircut to take, right? And again, I am making a push for a lot of smaller traders to find alternatives to be able to learn in the market environment and have a lower learning cost associated with the trade. That same trader who risks and comes in here and says, okay, I have a 5K account, right? And I can risk 2 contracts at $38, right? So now he's risking about $70, and now his risk is just over 1% per trade. This makes, when you reduce your risk per trade to 1%, right? And let's say he doesn't get, let's say he simply doubles each time, so he's going to make $68, but his commissions are extremely low, right? And now this depends, now you find out on this trader what that trader really is in the market for. Because if that trader goes, well, it's only $68 that I make per trade, right? If he looks at it for this and he has a high win rate, he can stay in the game a long, long time while he finds ways to build his capital. He's not trying to hit a home run. This trader is trying to learn how to make money so that he can eventually go, A, to trading full contracts, or at least full mini contracts in the futures, and B, he's committed to staying in long term so he can raise his capital over time, learn how to develop a high win rate, right, and avoid having massive anxiety-driven drawdowns that just really rack your brain, hurt emotionally, you name it. I've seen people go through it. It really, really sucks. Okay, so I'm not advocating that people not trade futures. I like futures, right? What I am saying is clients that have small accounts and are new to the business, that you need time to acclimate to trading, and that the binary options give you an opportunity to learn, and they teach you to learn from a trading plan, from a risk reward perspective, right? And from managing your account properly so that you can be in this business for a long time. The reason why I'm going through this long song and dance is because retail futures accounts go to zero at the rate of over 70% in this industry. Think about that. That's not the other 30% are winning. The other 30% are there's only the top 5% that are actually making money. 70% go out broke. So if you cannot stay through the learning curve, if you cannot learn how to take risk appropriately and how to make an appropriate both in terms of time that the trade will take and risk management, right? You have very little chance of succeeding in the long term. And I've seen this happen again and again to very small traders. The flip side of this is for larger traders, you still are constrained. What are the constraints of taking all these trades? In one of these zones, the constraint is 20 minutes, right? 15 to 20 minutes. And I cannot tell you how many times I've come down, hit support, and watch a trade stay in here for 45 minutes and then make a bounce to the upside. If you want evidence of that, you just have to go back a month ago. We would sit and consolidate in one space for over 45 minutes. I'll give you another example of that. Let's say for some reason you thought the short was here, right? You took a short here, and let's say you even nailed the top of this, right? And you thought we were going to roll over back down here. A futures client who takes this trade, this is 5, 10, 15, 20, 25, 30, 35, 40, 45, 50 minutes that we sat here. Now, picture that, right? You are not only are we trading a leveraged product, right? So the futures product is by nature more jittery than a non-futures product, even if you're not trading leveraged. But the reality is most people who are trading futures are trading leveraged. So you're sitting there. You realize when you look at this chart that you've taken a short, that we've pushed to new highs on the day. You're betting that we're going to come back in on a balanced day, right? And you can't get any movement more than 1 or 2 points for over 45 minutes. The odds that you stuck with this trade and stay with your convictions are very, very low. However, so how do you fix this problem? One, you lower risk when you're taking a higher, more aggressive trade to the short side on a day where buyers are in control. Number 2 option, you can, again, if you know your risk per trade, let's say you're a larger trader, and your risk per trade is, let's call it $2,000 or $3,000 per trade, right? And you go, okay, I can use binary options because they move very quickly, because the delta on a binary option kind of goes like this in a 2-hour window, very short. Like it opens and pretty much goes like this. There's not a very high lifespan on a binary option. So you can look and say, okay, I think within 1 to 2 hours, I can get a move down on this trade. I'm willing to risk X number of dollars on that. The only piece you have to figure out at that point is which contract you're going to trade. And then if you are wrong, right? If you are wrong, you know that you've lost X number of dollars. But that's so much better than being in here and having a high amount of leverage and knowing if you're wrong, you have a massive amount of risk, or even worse, knowing that because we're wiggling and you're using a tight stop, that you just get stopped out only to watch a trade go down 45 minutes later. The binary contracts offer, in my eyes and in my own trading experience, offer a solution to that. So that's why I've added it to the room. And I think it's an important component. So let's go back to, because I've dragged on much longer than I wanted to. Let's go back to the trade. So we have a huge rotation down. This is a virgin touch of this zone, right? We recognize that buyers are in control. The range in the first hour has been significantly smaller. It's from 2064 to 2069, 5-point first hour range, right? So we know that we're expecting a balanced day, meaning we think we'll have a move back into the middle, first touch of the zone, and then buyers are in control. We take this first long. I called it out in the room. I'll edit it out so I can post it later for those who want to see it. Whether you, I actually called the option trade late here because I was focused on getting the futures trade, and the trade eventually moved up here. Now, I want to say something else. I thought we were going to drive down, get initial sellers, and then push to the upside initially, and I took a long in the binaries, and I believe I took those long. I don't have my spreadsheet in front of me, but I believe I took the 2070 calls that expired at 10 a.m. for $27. Now, here's the deal. I was wrong. This was aggressive trade location. I really took that trade right back here. Okay, I want to show exactly why this was a beneficial trade. I risked $27 per contract. Now, normally if you're a small trader and you took the futures trade here instead of the options trade, if you took the options trade, you had the opportunity, if we turned quickly and the market got aggressive, to make the move to 2070, you had the opportunity to do very well in this area. You were not having the time click against you, right? And your risk was minimized. I believe $27 was the entry. And no matter how far this moved down against us, this could only go to zero, right? This is versus even a small to mid-size account taking 2 contracts out of location, right? Even though I got the swing long, at this point I had my swing long indicator tell me that we were probably going to start to move to the upside. It was early, which is not unusual. If I'd taken the futures contracts at 2064, there's very little odds that I held it for a 5-point rotation back to capture this move out. This would have required me per contract to risk $250 per contract, versus in the options, right, I would have risked, well, $27 and then multiply it out, whatever it was that I was going to get, right? But let's do the math through this, right? At $27, the most I could have made was $100 per contract if it went up, right? Now, let's get this balance for balance so I can show you the difference. Out of location, higher risk, $27. Higher location, my risk on this trade became $250. And since my entry was an aggressive entry at 2064, that means if I wrote it all the way out to 2072, it was 8 points, I would have made $400 per contract, right? At $27, and I was willing to risk, let's say I had a total risk available of $200, right? At $200, had I risked it, that would have opened the door to me to having, let's just call this 25 for 8 contracts, right? And had I gotten the trade correctly, and that would have been an investment, if we're using math, of $25 a contract, let's call that the same $200 for sake of conversation, would have given me an $800 potential upside, which would have been the same equivalent had I used, let's see, 64 to 72. That would have been 6 times 6 points, $50 a point. That's $300. So I could have made either $600 on the futures contracts while risking what was eventually that model assumes that I never had a stop in, right? While risking $250 or a $500 loss per contract, or I could have simply taken a fixed amount and gotten the shot to the upside. Now, as it turned out, I was early here. All I had to do, even if I parted it out, was reload the position here, and I still would have ended up with the swing up. Anyways, I'm not being as clear as I want to be. The point being is, if you're a small trader, and importantly, you have the win rate, which I believe I do, that there's an enormous amount of money and a very good way to reduce your overall risk versus trading futures. And so I'm going to be using that in the room. Here's the other point that I wanted to make, and I apologize, this dragged on a lot longer, and I'm sure I've lost a lot of y'all by now, but I want to go into this. People were asking me, well, do you want to short up here? And that was a really good question, right? Looking in hindsight, yeah, that would have been a fantastic short, right? The first thing I noted, I said, I really don't want to short. First of all, we had this open drive higher to new highs. Look how long it took when you're trying to figure out if buyers or sellers are in control. This move right here took from 10:30 in the morning, London close, all the way till 1 o'clock in the afternoon. 2.5 hours to move essentially from 2072 to 2066, 6 points, right? When we're up here, people are asking me if I want to short the open gap, and normally I do. So first of all, my argument is we're in the last hour. It becomes a much more difficult trade. Number two, took 2.5 hours to move down, to move from the low at 2066 just before 1 o'clock, right at 1 o'clock actually, to testing the open gap at 2073. That took a move of just under 50 minutes, right? I always want to be trading, if I can, with the guys who have the easiest and most force to the upside, right? That does not mean I want to be buying up here for a continued push to the upside, but as sure as heck does not mean I want to step in and figure out which side is short. Also, if we look at the chart, pull this in here. Okay, look at the last couple of days. This day, we pushed to the low at the end of the day. Taking a short actually made some sense. I was short here. I don't remember if I was short here. I know I was short throughout the day. I don't know if I was short here. Actually, I take it back. I was short here. I don't remember if I was short here. But here's my concern, right? When buyers are in control, as they clearly are here, notice this looks like the opposite of this and this. Why do I want to bet that this is going to break when buyers have clearly been in control all day long? These shorts make sense in this area. This makes absolutely no sense. What I felt was the risk when we were up here was that we would get a dog leg up like this in the last 30 minutes of the day. I don't want to take that risk as a trader. Why? I want to bring it back to the 3 C's: clarity, commitment, and composure. If I can't keep my composure as a trader, if I can't keep my anxiety levels down, if I can't keep my focus at a high level, and I can't stay in a learning mode, then I am never going to learn what the market is trying to communicate to me. Furthermore, and very, very importantly, if you are always hanging yourself out on the jagged edge and trying to capture every move, it'll be very hard to stay in a calm, centered, balanced way that professional traders need. So you simply have to make a choice. Some people are in the market because they want action, okay? The people who want action, they can short these moves at the highs all they want. They will always have excitement. If you're betting on the short side, majority of the time, you're going to lose at the end of the day. But whatever, most people who are doing that aren't in the market to make money anyways. Because when you're in the market, it's just a business proposition. That's it, right? So what did we accomplish on this? So my point is, you will not see me trying to capture these. That was for prior to this being a real business for me many, many, many years ago, right? On days like today, like this, prior to days, yes, you'll see me pressing the short, but not on days when buyers have been in control. We're trading above the first hour high. That doesn't make any sense to me whatsoever. It's a low odds proposition. One last piece when you go into the day. I essentially in the room had 2 trading calls, right? I had one, which I noted was very aggressive because of location. And we minimized risk. I have too many drawings on this one. Let me get the other one here. Here we go. How did I come back to, did I manage my risk well? I did not take futures here. I used options, and those options closed out at 0. I was able to manage. I had minimal risk to give myself an upside shot. That trade didn't work out. My first move into my zone on a good stretch, I took this and immediately I said, guys, this is good position, leave a stretch. My scales were 2, 4, 5, I believe 9 points was my last scale on that trade. When you know what you're looking for, you're patient, and you know how to balance the risk from point A to point B and which trade is your trade, and that comes from having a written trading plan, it becomes much easier to capture these trades. We will be doing a lot more swing trades, or I'll at least be highlighting areas where I think we can get swing trades out of. And overall, we had a great week in the room. The zones have been on fire. First touch of the zone has been great for a trade, both short and long on most days, right? And I love the volatility, so I hope that the volatility continues. Anyways, I hope I helped. I know I'm making a big push into the binaries. I will be publishing the spreadsheets as soon as I figure out how I want to structure them. And I will again be publishing the win-loss rate out of the zones as well. I think that's something that I've gotten away from and need to go back to. So anyways, that's what I got, guys. I hope everyone's having a great weekend. The one thing that I can stress for anyone who's trying to learn to become a consistent, profitable trader, have a written trading plan. Have an active journal. Use active spreadsheets where you're manually inputting your wins and your losses so that you can visually see and reinforce when you're doing well, and you can immediately highlight what was my poor decision and tie that back to your journal. Becoming a good trader, right? Becoming a great trader is something that takes work, but I really believe everyone's capable of doing it if you're willing to submit yourself to the fact that we're just a slave to the price action of the market. And we just have to be clear on exactly what we're going to do on every step of the way in terms of our actions. Then the winning and then the making money becomes much, much easier. My name is Simon. I'm with Trade and Perform Coaching. I appreciate your time, and I hope you're having a great weekend. Talk to y'all later.